Good morning, everyone. So hope everyone is doing well, and thanks again for joining our webinar. So I'm going to be doing the first part of our presentation this morning, and I hope everyone maybe has a strong coffee or whatever beverage you choose to get us rolling with some good GASB information here this morning. So first couple slides here on our presentation, just a little bit of bio information about myself and Tina. I'm not going to take time to go through those details. Certainly have that information here within the slides. We will jump right into the standards. So this morning, we're not going to talk about every GASB that's on the horizon here becoming effective. Really going to focus on a few key items. In the first part of our presentation here, we're going to talk about leases and GASB 87. And I will say that this is a standard that you go back a year and a half, 2 years ago, I think was getting a lot of buzz, a lot of focus, because it is a significant standard, especially if you have a lot of leases. But then this little thing called COVID-19 happened and kind of diverted all of our attention to many different places. Having said that, even though there was a little bit of a delay with GASB 95, this standard is now, it's upon us. It is becoming effective. You can see the effective period down there in the bottom left corner. It is for periods beginning after June 15, 2021. Obviously, that date has passed. So if you're a fiscal year end, say June 30, you're looking at July 1st, 2021 is the beginning of that implementation period. If you're calendar year end, then you'd be looking at 2022 calendar year for the year of implementation. So to get into some specifics here, we're going to talk about the scope of this first. And there's some importance to this slide and this information because there is a very specific definition of what is a lease within the standard itself. And that's something that needs to take a little focus because you may have some things that you don't call a lease today, but really do meet this definition and will be considered a lease under the standard, or maybe vice versa in terms of that. So what is that definition of a lease? Well, a lease is a contract that conveys the control of the right to use another entity's non-financial asset or an underlying asset for a period of time in an exchange or exchange-like transaction. We do have the definition there for exchange-like transaction, but what I want to focus on is a couple pieces of that definition. So you have this right to use asset that it's got to be specified in the project. So there's some kind of asset there, but that right to use is important. When we start to look a little bit further here at the asset itself, it's really an intangible asset. So you have that right to use the asset. The other aspect there is control. And that's manifested in two ways. You have the right to obtain the present service capacity from the use of the underlying asset. So you have the right to use it. But, and this is critical, you also have the right to determine the nature and manner of the use of the underlying asset. So you're not just using the asset, you're controlling that asset and determining how it's used. So you may have the rights to use something, but if it's not exclusive to you and you don't control that underlying asset, then it doesn't meet the definition of a lease. And you may have some things today that you call a lease that don't meet that part two of the definition. So that's something to keep in mind as you examine your lease transactions or your potential leases, understanding what that definition is. So what is specifically excluded? We have that kind of general definition, but there are some specific exclusions. So GASB 72 is the one that deals with investment. So if it meets the requirements in GASB 72 to be an investment, the lease accounting is not going to apply. Intangible assets, you may have some of these mineral rights, patents, software, copyrights, those types of things. Those are other intangible assets. This lease standard not going to apply. Biological assets, maybe timber rights, does not apply. Inventory, service concession arrangements, assets with outstanding conduit debt, not going to apply. But supply contracts, and this is a key because we do see this from time to time. You may have a power purchase agreement, probably not going to convey the control of rights in the underlying generating facility as part of that agreement, so it's not going to apply. And that's kind of an example there where you see you may have the use of the asset, you're receiving the power, but you don't control the asset itself. So the next slide, and I will say, we kind of hit this right up front, but this is a standard that requires some judgment. And so it's one that management's definitely going to have to be involved in the examination and understanding the details of your leases. And this is the first thing right out of the gate that's going to require some judgment, especially if you have extension periods built into your leases. So what is the lease term? And you'll see as we get into the calculations in the accounting, all that is driven off of the lease term. So the lease term, you start with the non-cancelable period plus any of the following periods. So you look at the lessees first. If the lessee has an option to extend and you're likely going to exercise that, then that's a period that's going to be included in the lease term. If the lessee has the option to terminate, then you're likely not to exercise that. That period is going to be included in the lease term. Or vice versa, the lessor has those same options. Now, one critical element here is it has to be the lessee or the lessor has those options. If both the lessee and the lessor can cancel or has those options, then that's a cancelable period and you automatically do not take that into consideration. So let's put this in the terms of a lease, not to get into details of it, but let's say that you have a 5-year lease and you have five-year extensions that are possible in that lease. And let's say it meets one of those first two of the lessee options. So if that is the case, you have a 5-year lease, but you have potentially 25 more years of possible extensions. So that likely to exercise comes into play in determining the lease term. You don't automatically use 5, you don't automatically use 25 plus 5 or 30, but you need to use your judgment and make a determination. Here's how many of those extension periods that we believe we are going to exercise. And that is what is going to drive the lease term. So again, that's very critical determination and something that is going to take some judgment in a lot of leases. So the next slide, you may have heard of short-term leases. If it's a short-term lease, we don't necessarily need to worry about all the mechanics of this complex accounting. And you may have short-term leases, but what is a short-term lease? What is that definition? And there's some difference from what we just talked about. So a short-term lease is at the beginning of the lease, the maximum possible term under the contract is 12 months or less. For a cancelable lease, you might have a month-to-month lease or a year-to-year lease. That maximum possible term would be the non-cancelable period, including any notice periods. So what's the key there? It's the maximum possible term. So if you have a month-to-month lease that has an automatic renewal extension, well, the maximum possible term, it may be much further beyond 12 months. So if that is the case, then it's not going to meet that definition of a short-term lease. However, the next bullet point there, if it is a short-term lease, if it does meet that definition, the maximum possible term is 12 months or less, then essentially you're going to do the accounting pretty similar to a current operating lease. So all the significance of this accounting is not going to come into play if you truly do have a short-term lease. So what about transfer of ownership? Some leases contain a transfer of ownership at the end of the lease. Now, we're not talking about a bargain purchase option here, but an actual transfer of ownership at the end of the lease. So if that is the case and you do have a transfer of ownership, essentially that's what we're calling a finance purchase. So you're not going to use this accounting. Now, that's not to say that you're not going to record the transaction, but it's really more like a note payable that you're financing the purchase of an asset. So you're going to book the asset, you're going to book the note payable. So you still have transactions. You're just not calling it a lease and using this accounting. That lease, in order to fall into this category, can't have any termination options. You can have fiscal funding clauses or cancellation clauses that may be common in governmental leases that allow you to break the lease under certain circumstances. Those are okay and still be considered this transfer of ownership. So now we're going to start to get into the calculation itself. So the lease liability is the first part where you really start with the calculations. So we'll get into some of the details of what's included in the lease liability, but really what you have to think about in terms of the mechanics of recording this transaction is you're going to determine what your future payments are over time for the lease, and then you're going to discount that back to today's dollars, something that we're all familiar with and very common in accounting. So what are the future payments that you take into account? And this is where there can be some complexity here as well. Now, you may have a very kind of plain vanilla lease that is not hard to come to that determination, but many leases have multiple components built into the lease, and some of those may need to go into the lease liability and some may not. So what is included? Well, fixed payments, that's the easiest thing right off the top, that those things would be included. Just a note here, if you do have variable payments that are included and they dependent on an index or rate, you're going to measure that at the initial rate. If you have variable payments that are fixed in substance and there's a floor to that, those get included. Other types of payments, not going to go through every bullet point here, but other types of payments that you may be paying out, and it's reasonably certain that you're going to do that, residual value guarantees. If you do have a purchase option at the end, not a transfer of ownership, but a purchase option, and you expect to exercise that, you're going to include that in there as well. So I'll note there on the bottom, again, the discount rate that we talk about, you're going to use, if it is built into the lease or if it's disclosed, that's the discount rate that you're going to use. If it's not disclosed, you may be able to get that from the lessor to determine what that discount rate should be. However, if you can't obtain that, you're going to use your own borrowing rate from the lessee perspective to use that to do the discounting calculation. We don't get too much into it in today's presentation, but I will mention that it could be a circumstance where you need to remeasure this lease liability in the future. Various things may change with the lease, maybe some of your judgment in terms of how long the lease term is going to be that we talked about. So if that's the case, you may need to remeasure this lease liability. So the next slide, this is out of the implementation guide. And we'll talk about that just a little bit more later. But I like this chart because I think it gives a good summary of some things that are included in the lease liability calculation and some things that are not. Then we start to talk about the lease asset or that intangible asset. So what is included? Well, you have the base payment, fixed payments, obviously they're included. So in this example, you have a 5-year lease for $1,000 a month. So discounted back at 4%. So that's $60,000. Discounted back to $54,480. Here's examples of two things that may be in your leases that would not be included in the calculation of the lease liability. If there's some sort of excess use charge, it's a variable payment, but that's not going to be included because it's based on the future usage of the asset. Maybe there's a service component. Many leases do have that, a repair, maintenance, or a service type component that's included within the lease payments. That is excluded. That is not going to be part of the lease liability calculation. However, I will say that sometimes that is embedded and it's difficult to know exactly what that service amount is. So the standard does say that you can not carve that out if it's not practicable to do that. So that gives us our initial value of the lease liability in this example. And then you have, how do we get to the lease asset? So here you may add on a few things to that lease liability to get to the lease asset calculation. We have delivery and installation, those types of costs, other initial direct costs that are included to put the lease asset in service. Those items are going to be added on to get to the initial value of the lease asset. So just a little bit more on the lease asset itself. As we talked about here, the things that you really start with your lease liability, a few potential add-ons to calculate that lease asset. So the asset itself, that's going to be amortized over the shorter of the lease term or the useful life of the asset. Now, if you do have a purchase option, and you're likely going to exercise that, so you're going to own that asset in the end, then you're going to amortize it over the useful life of the asset no matter what. If it's land, obviously you're not going to amortize land. And generally, that lease asset, if there is some sort of remeasurement that we talked about, you're going to remeasure that lease liability, and that's offset through the lease asset in terms of that transaction. Now, if it's a significant adjustment, it could actually reduce the lease asset to zero. In that case, any remaining would be booked as a gain. So how about financial reporting? We're going to talk and get into the nuts and bolts of some of the details of actually booking the transactions. But the first bullet point on this slide does talk about fund level accounting. Now, there is some nuance here between the lessee and the lessor. For the lessee, and when I say fund level, let's talk about governmental funds and modified accrual accounting, such as your general fund, if you have that. In that situation, modified accrual accounting, you're not booking all these complex transactions there. It's going to be very similar to how you record long-term debt today, where you have proceeds from a lease and you have an expense. All the asset liability calculations, they're not going to be at the fund level. They're going to be at the government-wide. Not that they're not required, but they're going to be at the government-wide at that GASB 34, as we say, level of the financial statements. However, for the lessor, if you are in that position, the lessor accounting, that is actually required at the fund level. So how about disclosures? Well, Haven't talked about it too much, but here's where, we'll start to broach this a little bit in terms of the complexity of this standard. If you have one or two leases, this, there's going to be calculation, but might not be two owners. It's when you get up to a significant volume of leases, 5 leases, 10 leases, 20, maybe you have 50 leases or more. That's where it's going to require a lot of effort for the implementation of the standard. And disclosures is one place where that's going to be. You have to include in the disclosures general description of the leasing arrangements. If there's variable payments that aren't included in the calculation, residual value guarantees not included, those things have to be disclosed. The asset itself, we talked about that lease asset, that's going to be included in your capital asset footnote. You may be thinking of that table that shows beginning, additions, deletions, ending, broken out by significant category, land, building, equipment, et cetera. But you're going to have a new category on that for lease intangible asset, and that needs to be broken out by building, equipment, land, et cetera itself. So that is going to grow, and obviously you need to be tracking those intangible assets separately. Expense and expenditure are variable payments that are recognized in the current period, not previously in the liability or residual value guarantees and termination periods. Again, a little bit of disclosure if you have those items that need to be in the financial statements. Of course, we have, excuse me. All right, well, we're jumping ahead here a few slides. Let me get back. There we go. So the disclosures here, just to continue on that, we have the principal and interest requirements to maturity for each of the 5 subsequent fiscal years and 5-year increments thereafter. So very common disclosure that we're all used to if you have debt, and basically the same disclosure that's required for those leases. Some other items here that would go into the disclosures as well, but you're not necessarily going to have on every single lease. So again, if you have just a few leases, might not be too onerous to creating the disclosures. The more leases you have, the more significant that's going to be. So let's get into the accounting a little bit. So the initial account reporting itself, there we go. The initial reporting itself, you're going to let's look at the lessee side first. So again, keep in mind, we're not talking fund level here. If you're talking about governmental funds, this is the general fund. So you're going to calculate that liability first. We talked about how you do that, the future payment stream discounted back to the present value of today's dollars. So you've got the liability and you have the intangible lease asset, the right to use the underlying asset. And again, you're not booking the asset itself, you're booking this intangible asset. On the flip side, for the lessor, and one key component here, the lessor, they will continue to record the actual asset itself. So whatever that underlying asset is, that's going to stay on the lessor's books. They're going to book a lease receivable, which is essentially the same calculation as the lease liability for the lessee. And then that lease receivable is going to be offset by a deferred inflow that will eventually be recognized in revenue. So how about in subsequent years that after the inception of the lease? So the lessee, you're going to, if you think about your fund level or your operating rent expense as the initial payment that you're going to have at your fund level, what the government-wide level or the full accrual level, you really have 2 components to the expense. You have the amortization of the intangible lease asset, and then you have the liability itself that's going to be reduced, then you have the liability as payments are made on that lease. You've got a reduction of the principal, and then you have interest expense. The lessor, for the transactions, you're going to continue to depreciate the leased asset, and then as payments are received, you're going to reduce the lease payments receivable, and then you're going to take that deferred inflow and you're going to recognize that into revenue over a systematic and rational manner. So I'll show you a few tools here. And this shows you just an example of a spreadsheet. I know it's kind of small on the slide. We're not going to go through this in detail, but this is what it could look like if you're going to use Excel to gather all of this data. It shows a few leases, all the critical elements that you have there in terms of the individual leases, the useful life of the asset, the interest rate, the term, gets into the calculation of the liabilities, payments before the beginning of the lease, et cetera. So those are items that you're going to be wanting to accumulate. So ultimately, and what we don't show in the presentation is you're going to use that data to generate amortization schedules. And you're actually going to have essentially 2 amortization schedules for each lease. You're going to have one for the asset and one for the liability. So, and don't give examples here, but you have to think of how are we going to implement this standard? Are we going to do this with Excel and do that to gather the data, generate the information, or are we going to use something more complex like a software program? And there's many out there in terms of choices, but that's an evaluation that you'll need to do and a discussion with those who prepare your financial statements as well. So just a little bit on the journal entries. We'll go through these relatively quickly. This just shows you an example of the lessee where the first journal entry there would be you lease that asset at the fund level, modified accrual where you've got the proceeds from the lease, equipment purchased. Then you're going to convert it at the government-wide level. So you're converting it to you might have some prepaid lease expenses. You're going to book the leased asset, the lease liability, and record those transactions and wipe out that equipment purchase and the proceeds from the lease. Then subsequently, again, the amortization of the lease asset, taking that rent expense and crediting that and converting that to a reduction of the liability and interest expense. Just to go through those relatively quickly. On the lessor side, here you're going to actually purchase the piece of equipment. So that's the initial transaction there. Then you're going to do the calculations, record that lease receivable and the deferred inflow of lease. And then in the future, as the lease moves on, continue to depreciate the equipment through that first part of that third entry. And then take a portion of that rental income and convert that to interest income and reduce the lease receivable and the deferred inflow. So obviously a number of journal entries that will need to occur for each of the leases. So let's get into a little bit of implementation guidance here. And there is a very robust Q&A that is available from GASB that walks through a lot of questions. And if you have any lease of complexity and you're not sure how to handle that, that's the first place that you want to go. So I just have a couple Q&As here to go over to flush out a few details. So this first one gets on this concept of additional components of the lease that would be built into the lease. So let's say that you have a copy machine, and part of that lease is there's a minimum amount that needs to be paid for toner and paper, actually regardless of whether the supplies are obtained. The question is, should some of that be included in the lease liability? So as with many things, the answer to that question is, well, it depends. And there could be some judgment here. So if the expectation, the amount of paper and toner that you have to record in that circumstance, if that is routine and expected to be what you would record, what you would use, then that's just a service component more or less, and you're going to expense that as you go. It's not going to be recorded in the lease liability. However, if it's not reasonable, it's an unreasonable amount, then it could be an in substance fixed lease of payment, and that's going to be included in the liability. Next example here talks about school buses. And let's say you have a lease for school buses, and a separate component of that lease is there's a variable payment that's based on the number of miles driven. So do you need to include that? And you may know it up front. Obviously, you have your bus routes. You may know exactly what that charge is going to be or something very close. Does that need to be included in the lease liability? Well, the answer to that is no. And that's an example where it's based on the future use of the asset. So because it is based on that future use of actually how many miles you drive, it's not going to be included in the lease component in those calculations. That's going to be expensed as you pay it. So get into a little bit here of actually, implementing things and what about grouping of leases? You may be thinking, well, you might be a school district. Let's say that you have 500 Chromebook leases, and you're maybe having a headache right now thinking that you're going to have to track all 500 leases separately. You can group the leases together, and that may be a very good idea if you have a group of pretty much identical leases, and especially if the lease term on those leases is going to be the same. Grouping can save you a lot of time. However, a word of caution, where grouping becomes difficult is when you kind of unravel that transaction or dispose of that transaction at the end. If you're not going to eliminate those leases at the same period of time, that can cause some real complexity there. What about materiality? GASB never really hits materiality head on, But if you look at the back of every standard, they do mention that if you have something that is immaterial, that you don't need to implement the standard. So I would offer to you, which may not have been what you've done in the past, but I would offer, if you're an organization with a $50 million budget and you have one copier lease that costs you $3,000 a year, that's probably immaterial and you don't need to worry about this standard. But that is a judgment call. That's something that you as management needs to determine. So you likely have some sort of capitalization threshold for your assets. Certainly that can also apply to this intangible lease asset that we're talking about. But what's that do for the liability? You don't have a capitalization threshold for a liability. Well, you need to consider that, and there's no definitive guidance here. You got to look at your leases. If you have one lease, maybe it could be immaterial. If you have 50 leases for small dollar amounts, well, in total, that still may be material, even though individually it's not. So bottom line, it can be a consideration, but something that you want to be careful about in terms of determining how to implement the lease standard. As far as transition, you may have capital leases today, and you might be thinking, well, maybe and the capital lease numbers through the transactions may not be that much different. You may be thinking, well, maybe we can use that as our starting point. And this example has a lot of numbers. I'm not going to go through that here this morning. But the answer to this question is really no. You have to look at the beginning of the implementation, really the earliest period that you're going to show on your financial statements. But let's say that's July 1st, 2021. Then you're going to look at all the payments in the future for the leases that you have at that time. You don't have to go back to the beginning of the lease and kind of redo these calculations from the beginning of time for each lease. You really look at that beginning of the implementation period going forward, do the calculations, and then whatever that starting point is of that liability and that lease asset, that's what's going to be recorded on your books at that point in time. And you're going to, if you do have capital leases, they're just going to go away through kind of a restatement of those prior year numbers. So finally here, where do we start? And hopefully you already have, but where do we start with this process? Well, obviously you got to consider the starting point for the calculations, determine what that's going to be for your organization. I just have the beginning period of the first implementation period here. Obviously identifying all of your leases. And again, maybe you have some things that you don't consider leases today, but do meet that definition. So consider all of your leases, start to gather that data, make judgment calls where they need to be made on the lease term, determine the interest rates, figure out the payment terms. If there are multiple lease components, you want to take a look at those and make sure that you're starting to get an understanding of what those components are and which ones need to be broken out. Are you going to do any grouping of if you have a significant number of very similar leases? Does it make sense for you to group those leases together in your calculations? Are you going to use some sort of capitalization threshold? Is there something that can be considered immaterial? Judgment calls that need to be made. As we talked about with the calculations, essentially each lease is going to have 2 amortization schedules. So those need to be built out. What's the process of that going to be? Who is going to prepare those amortization schedules? Again, footnote disclosures. Every GASB, as we know, comes with more footnote disclosures. So it could be kind of plain vanilla with your leases, but if there's complexity, that's going to bring some complexity to those footnote disclosures as well, and obviously summarizing that data. So a lot of information there very quickly, but that's what we have on leases this morning. And I'm going to now turn it over to Teena for her to go through her portion of the presentation.
Good morning, everyone. My portion of the presentation is going to be working through a couple of the upcoming GASB standards that were recently implemented, and then talking about one that is on the horizon as far as being in the works of getting finalized in the near future. So the first standard that I'm going to be discussing is GASB 96. This is the subscription-based information technology arrangements standard. And as with everything else in the accounting world, with all of the very long worded activities and everything and standards, there is an acronym for this. So for the most part, through most of my presentation, I'll be referring to this IT arrangement, but I will not be saying the full words the entire time because that will take up the whole presentation. But what we're going to talk about is this standard, the objective, some definitions, the effective date that you'll need to be aware of, and then some of the details about the standard. This standard is going to be very similar to the lease standard that Craig had just talked about. So a lot of the wording, the terminology is going to be similar or exact from what he had mentioned. So as you implement the lease standard and go through that implementation phase and get the experience for that, there will be a lot of similarities with this standard. So when it comes time to implement it, there should be a little bit more experience and knowledge that you would have gained through implementing the lease standard that you could use to help in implementing this standard as well. The objective of this standard was to better meet the information needs of financial statement users by establishing uniform accounting and financial reporting requirements, improving the comparability of financial statements among governments, and enhancing the understandability, reliability, relevance, and consistency of that information related to these IT arrangements. The definition in the standard of a subscription-based IT arrangement is a contract that conveys the control of the right to use another party's IT software, alone or in combination with tangible capital assets, essentially the underlying IT assets. For that's specified in the contract for a period of time in an exchange or exchange-like transaction. So Craig's presentation, he outlined the definition of an exchange transaction. So you can refer to that. It would be the same concept here that you would be applying for this standard as well. Control is met if the government has both of the following: the right to obtain the present service capacity from the use of those underlying assets, and the right to determine the nature and manner of use of the IT assets. So again, very similar to what Craig had mentioned with the lease standard. The effective date for this standard is periods beginning after June 15th, 2022. So that means June 30, 2023 fiscal year ends and calendar 2023. Earlier application is encouraged. The subscription term is defined as the period during which the government has a non-cancelable right to use those IT assets, plus the following periods if applicable. Any periods that are covered by the government's option to extend or terminate the IT arrangement if it's reasonably certain that the government will or will not exercise that option, and any periods covered by the vendor's option to extend or terminate if it is reasonably certain that the vendor will or will not exercise that option. So again, very similar to the lease standard. And as Craig mentioned, for the lease standard, the common fiscal funding or cancellation clause that is seen in a lot of these contracts, that should affect the subscription term only if it's reasonably certain that that clause will be exercised. The standard does exclude contracts with standalone tangible capital assets and contracts with a combination of tangible capital assets and an insignificant software component, and also short-term subscription-based IT arrangements, which is defined as less than 12 months, including any options to extend. The subscription liability should be initially measured at the present value of subscription payments expected to be made during the subscription term. Future subscription payments should be discounted using the interest rate the IT arrangement vendor charges the government, which may be implicit, or the government's incremental borrowing rate. The subscription asset should be initially measured at the sum of the subscription liability plus payments made to the vendor before commencement of the term, and any capitalizable implementation cost, which we'll talk about in a subsequent slide, less any incentives received from the subscription vendor at or before the commencement of the subscription term. Activities associated with a subscription-based IT arrangement, other than making subscription payments, should be grouped into the following three categories, and their costs should be accounted for accordingly. The preliminary project stage, including activities such as evaluating alternatives, determining needed technology, and selecting the vendor, should be expensed as incurred. In the initial implementation stage, including all ancillary costs necessary to place a subscription asset into service, should be capitalized as an addition to the subscription asset. And in the operation and additional implementation stage, including activities such as subsequent implementation activities, maintenance, and other activities for the government's ongoing operations related to that IT arrangement, should be expensed as incurred unless they meet the capitalization criteria. Training costs should be expensed as incurred regardless of the stage in which they're incurred. Remeasurement may be required if one or more of the following changes have occurred and are expected to significantly affect the amount of the subscription liability since the previous measurement. A change in the subscription term, change in the estimated amounts for subscription payments already included in the liability, a change in the interest rate the vendor charges if that is what was used as the initial discount rate, or a contingency is resolved that was based on variable payments that will now change. The exception here is no measurement is necessary if the sole change is the government's incremental borrowing rate. As Craig mentioned, with any GASB standard, there are disclosure requirements. So for GASB 96, the footnote disclosures that will be required are a general description of the subscription-based IT arrangement, including the basis, terms, and any condition on which variable payments that are not included in the measurement of the liability are determined. The total amount of subscription assets and any related accumulated amortization disclosed separately from other capital assets. Just like Craig mentioned with the leases, this will be the same situation for the subscription-based assets. The amount of outflows of resources recognized in the reporting period for any variable payments not previously included in the measurement of the liability. Any amount of outflows of resources recognized in the reporting period for other payments, such as termination penalties that were not previously included in the measurement of the liability. Principal and interest requirements to maturity presented for the subscription liability for each of the 5 subsequent fiscal years and in 5-year increments thereafter. So similar to how capital leases are reported now, how the leases, once the lease standard is implemented, will be reported. Same thing again for these subscription-based IT arrangements. Any commitments under the arrangements before the commencement of the subscription term, and any components of a loss associated with an impairment. As a note, for disclosure purposes, subscription liabilities are not considered debt that is subject to the disclosure requirements in GASB statement number 88. Now we're going to talk about GASB 97. This is mainly related to Section 457 Deferred Compensation Plans. So we have just a couple slides on this standard, going through the similar process, giving you the objective, the determination of the plans, the effective date, and then a little more details about the standard and how it will be applied. The objective of the standard was to increase consistency and comparability related to the reporting of fiduciary component units in circumstances where these potential component units do not have a governing board and the primary government performs the duties that a governing board typically would. It also is the objective is to mitigate costs associated with the reporting of certain defined contribution pension plans, and as with all standards, enhance the relevance, consistency, and comparability of the accounting and financial reporting of these deferred compensation plans that meet the definition of a pension plan. So from a determination standpoint, a Section 457 plan should be classified either as a pension plan or another employee benefit plan. So if the 457 plan meets the definition of a pension plan, as disclosed in Statement 67, 68, or 73, it is a pension plan for accounting and financial reporting purposes. If it does not meet that definition, by default, it's considered another employee benefit plan. The effective date for this standard is portions of the standard are effective immediately, and this paragraph 5 in the standard is basically related to certain criteria for reporting of pension activity. And then the other portions of the standard are effective for periods beginning after June 15th, 2021. So what that means for your reporting purposes, for the most part, would be June 30, 2022 or calendar year 2022. In this standard, the component unit criteria supersedes several implementation guide Q&As effective immediately. And essentially what that means is when the pension and other post-employment benefit standards came out in recent years, there were subsequent follow-up Q&As to try and help expand on the information that was included in those standards, information that was missed in those standards, clarification of information. Now that this standard is out, this standard supersedes any of those Q&As as far as what the answers were provided in those. So this is the standard you do want to use and rely on when you're looking to for the accounting and reporting on these types of plans. Pension plans are considered legally separate entities for component unit evaluation. In the absence of a governing board where the primary government performs the duties that a governing board would typically perform, it is considered the same as an appointment of a voting majority of a governing board, except for defined contribution pension and other post-employment benefit or OPEB plans and other employee benefit plans. The financial burden criteria in Statement 84 is only applicable to defined benefit pension plans and defined benefit OPEB plans that are administered through trust that meet the criteria for GASB 67 or 74 for pension and OPEB plan reporting. So in the previous slide where I mentioned that paragraph 5 was applicable immediately, that's what this is referring to. So what this means is that in most cases, a defined contribution plan will not be considered a component unit of the primary government. It's not an automatic exemption from GASB 84 fiduciary fund reporting requirements. That will still need to be considered along with other criteria. Most importantly, who controls the assets, which is one of the criteria for reporting a fiduciary activity. Lastly, here, we are going to talk about a GASB exposure draft. So this is not a standard, so it doesn't have a number assigned to it, but this is one of the most recent projects that the Standards Board has undertaken. They've already been working on it for a few years now. They are getting closer to finalizing an actual standard related to it. So this exposure draft essentially is one of those final steps before the information gets formalized into a standard that will ultimately be implemented. This exposure draft is related to financial reporting model improvements. So basically they're revisiting how government financials are reported and disclosures, and even down to the fact of how activities or transactions are accounted for. So there's a lot that's going into this upcoming standard. What I'm going to be talking about today are a couple highlights of some of the areas that are being discussed as being included in the final standard. There are some additional pieces that I'll talk about tomorrow in the roundtable discussion to give you a little bit more information related to that, but I'm going to hit what we believe to be more of the significant potential changes that you may need to implement or think about as the standard comes near finalization. As far as management discussion and analysis is concerned, for many governments, this is part of the financial statements. It's usually preceding the basic financial statements. That will still be a requirement, that it precedes the basic financial statements according to this standard. Not all governments present a management discussion and analysis. It is a required component if you report GAAP basis financial statements. Some governments include it regardless, even if they record on a modified cash basis and it's not necessarily required. But most governments do include a management discussion and analysis component of their financials. So this is an area that would be applicable to you if you are presenting that in your financials. It will be limited to the following related topics, which are very similar to what is being presented currently: an introduction section, financial summary, detailed analysis, a significant capital asset and long-term debt activity component, and then currently known facts, decisions, or conditions, where as of right now, that information that's normally presented is significant activity that affected the government during the year, any upcoming information that is deemed significant and relevant for readers' information that will affect the government, so that will be included in that section as well. It will provide objective and easily readable analysis of the government's financial activities based on these currently known facts, decisions, or conditions, and present comparisons between the current year and the prior year, obviously with a focus on the current year in order to assist the users of the financial statements with an understanding of why balances and results changed from the previous year. It will avoid any unnecessary duplication by not repeating explanations that may be relevant to multiple sections. And it will distinguish between the primary government and its discretely presented component units. As far as budgetary comparison information is concerned, this is directly accounted for in this standard and spelled out. It will be required to be presented as required supplementary information and include variances between the final budget and actual amounts and variances between the original budget and final budget amounts. An analysis of significant variances would be presented in notes to the RSI or required supplementary information rather than in the MD&A. So currently, variance explanations regarding the budget are normally presented in the management discussion and analysis. This will no longer be included in that part of the document. It will be separately presented in notes to this RSI schedule, and it is requiring that the budgetary comparison information be presented as RSI, and it cannot be in the basic financial statements. It will be reported as a supplementary schedule in the financial statements. Another thing that the exposure draft introduces is a short-term financial resources measurement focus and accrual basis of accounting in governmental funds. So this could and will impact governments in certain situations based on the transactions that are being entered into in a given period. It would report elements of financial statements from a short-term perspective that is uniform across governments. It's based on whether the items or transactions arise from a short-term or a long-term transaction and other events. So balances, inflows of resources, and outflows of resources from short-term transactions and other events would be recognized as the underlying transaction or other event occurs. Balances, inflows, and outflows from long-term transactions and other events would be recognized when the payments are due. The exception to this is that any item associated with long-term debt issued for short-term purposes would be recognized as a short-term transaction. And we will see an example of that in a subsequent slide. So there's two examples here on these slides for this presentation that discuss potential transaction recording of transactions based on this short-term focus that is in this exposure draft. For example, notes receivable. If your beginning of year receivable balance of notes receivable was $4,387,776. $645,000 was matured and collected during the year. The end of year receivable balance was $3,742,776. This transaction is a long-term transaction because the period from inception to conclusion is greater than 1 year. An asset should be recognized when the payments are due. Notes that matured during the year should be recognized as an inflow of resources. So what would you recognize? What would be the recognized amounts in this particular situation or example? No notes receivable would be recorded for this transaction or this balance, and an inflows of resources of $645,000 would be reported as a current activity. Another example here, tax anticipation notes. Your beginning of year balance was $4 million, all of which was paid during the year. $4,400,000 of tax anticipation notes with a 15-month maturity were issued in the current year, leaving an end of year balance of $4,400,000. This transaction is a short-term transaction because tax anticipation notes are considered short-term transactions, that exception of long-term debt issued for short-term purposes. A liability should be recorded for amounts payable at year end. No inflows or outflows of resources should be recognized because short-term borrowing transactions affect only assets and liabilities. So in this example, you would recognize a tax anticipation note payable of $4,400,000 and no inflows or outflows of resources. The effective date of this standard is based on the government's total annual revenues in the first fiscal year beginning after June 15, 2022. So a little different than what we normally see for GASB standards, where there's a specific implementation date for everyone, and then they just say earlier application is encouraged. In this particular case, it's kind of a tiered implementation time frame. So everyone will use the same time frame to determine the annual revenues that will dictate the effective date, but the actual implementation requirement will depend on those revenues. So if you are a government with total annual revenues of $75 million or more, you would be required to apply the requirements of this standard for fiscal years beginning after June 15th, 2024. So you're looking at looking at annual revenues for your June 30, 2023 or calendar year 2023 to determine your implementation date. And if you are greater than $75 million, then you would need to formally implement this standard in your June 30, 2025 or calendar year 2025 reporting period. If you are a government with annual revenues of less than $75 million, you would be required to apply the standard for your fiscal year of ended June 30, 2026 or calendar year 2026. So earlier application is encouraged. You could implement it earlier if you desire, but they would be the latest based on the exposure draft right now when you would need to implement this standard. This proposed effective date provision would allow governments with total annual revenues of less than 75 million, so the smaller governments, to implement 1 year later than the larger governments, thereby enabling the smaller entities to reduce their implementation challenges by benefiting from the implementation experience of the larger governments. That was everything that we had planned on going through in this particular presentation as far as a GASB update on the more recent and significant standards that will likely be affecting most everyone on the call.